You can hit your number, you can be completely mathematically ready to retire and still fail retirement. I've watched it happen. So I'm going to give you 5 tests to pass before you hand in your notice. 2 are about money, 3 are about life, and every one of them ends with a pass or fail line you can check this week. But here's the part that surprises a lot of folks. 3 of these tests have nothing to do with your portfolio. And the one that best predicts whether you'll love retirement or quietly regret it is the test almost nobody thinks to take. But let's start with a couple who did everything right and were wrong by $30,000 a year. Hi, I'm Mark Fonville, a certified financial planner at Covenant Wealth Advisors in Richmond, Virginia, where we help over 550 families plan to and through retirement. Now, most people spend decades studying for the money exam, the number, the projection. Almost nobody studies for the second exam. In EBRI's 2026 retirement survey, 46% of retirees retired earlier than they planned. Mostly health or a company reorg, things they just didn't choose. You may not get to pick your exam date. So let's take the tests now. Again, 2 about money, 3 about life. Okay, so test number 1, the spending test. Here's the whole test in one sentence. Your projection is only as good as its inputs. And the input almost everyone gets wrong isn't the monthly bills. It's the lumpy stuff. I see it all the time in practice. So let me introduce you to Tom and Linda, both 62, $2.4 million saved. They're a hypothetical example and for illustration only, not actual clients, but I promise you folks like this exist everywhere. Now, when Tom ran his retirement projection, it needed one input. What will we spend? And Tom did what almost everyone does. He thought about last month's mortgage, he thought about groceries, he thought about utilities, and said $9,000 a month. The projection came back green, so they retired. Then February brought the property tax and insurance stack, around $14,000. Spring brought a $22,000 roof. Summer brought $9,000 in travel that wasn't really a vacation. Just family stuff. Add up the recurring layer, the taxes, the insurance, the travel, and spread that roof over the years it'll actually last. And their real run rate wasn't $9,000 a month. It was closer to $11,500. That's a $30,000 a year gap. Now, $30,000 didn't bankrupt them. It wouldn't on $2.4 million, but it quietly added more than a full point to their withdrawal rate every year for what could be a 30-year retirement. The danger isn't the one-year miss. It's flying the next 3 decades on the wrong gauge. Now, the projection wasn't wrong. The input was, and Tom and Linda aren't unusual. In that same EBRI survey, 2 out of 5 retirees said their overall spending in retirement is higher than they expected. That's 2 out of 5. Here's the problem. Nobody misses the monthly stuff. It's the lumpy stuff that breaks plans. Property taxes, the roof, the car, the wedding, and the one almost nobody budgets, helping a family member through a health crisis. And if you're retiring before 65, like Tom and Linda, add the one almost everyone underestimates. Health insurance until Medicare kicks in. For a lot of couples, it's the single biggest line on this whole list. Price it before you resign, not after. The roof does not care that you retired. This, by the way, is why when someone tells me their spending number from memory, we don't type it into the software. We pull the actual statements if they'll give them to us and let 12 months of data do the talking. Memory is an optimist. So here's your pass line. You pass the spending test when you have at least 12 months of real downloaded spending data. You've taken every lumpy expense from the last 2 years and spread it into your monthly number. And you've added a 10% buffer on top. If your projection is built on a remembered number, you didn't take the test. You guessed the answer key. But here's what would have surprised Tom and Linda even more. Passing the spending test just isn't enough, because the portfolio that got them $2.4 million was the wrong portfolio to actually retire on in the first place. So test number 2 is what I call the bad timing test. While you're working, one thing matters about your portfolio: the average return. Markets drop, you're still buying. Down years are a sale. But the day you retire, just the rules flip. You stop adding and start withdrawing. And now the order of your returns matters more than the average. And advisors call this sequence of returns risk. And in plain English, the risk of the bad years showing up first. Charles Schwab actually published a hypothetical example I think about from time to time. It's 2 investors, each retires with $1 million, each withdraws $50,000 a year, rising with inflation. Same list of returns, one difference. Investor 1 gets 2 15% losses first. Investor 2 gets those same 2 losses a decade in, years 10 and 11 instead. Same average return, investor 2 has hundreds of thousands of dollars left. Investor 1 runs out of money roughly 2 decades in. It's the same math, opposite lives. That's why the first 5 to 10 years of retirement are called the fragile decade. When you sell stocks in a down market to pay the bills, you turn a temporary loss into a permanent one. Oh, by the way, if you're finding this useful, do me a favor and subscribe. Just click the subscribe button, because the 3 tests left are the ones people actually fail. Now, this test is not, do you own bonds? It's functional. Could you pay yourself for 3 to 5 years without selling a single stock while it's down? A retiree who's mostly in stocks but holds a big cash and bond reserve might be able to pass. A 60-40 investor who panic sells in a crash can fail. So here's your pass line. You pass the bad timing test when you can point to the specific stable assets, cash, short-term high-quality bonds that would cover 3 to 5 years of portfolio withdrawals, while the rest keeps growing to outrun 25 or 30 years of inflation. And for many of our clients, we often build buckets that can endure upwards 10 years or more of withdrawals without having to touch stocks. At least that's the goal. So if your portfolio today looks exactly like it did at 45, you're basically doing highway speed in a school zone, at least from my perspective. By the way, this whole readiness question is exactly why we keep a retirement checklist library here at Covenant. So you can grab the pre-retirement checklist just by typing checklist in the comments. I'll be sure to send you a link, but let's go ahead and keep going with the video. So let's say you pass both money tests. Spending verified, portfolio built for withdrawals. Here's the uncomfortable truth. You can still fail retirement. The last 3 tests have nothing to do with your portfolio. In our experience, walking families into retirement, this is where almost all of regret lives. Test 3, the Tuesday test. Everyone can describe retirement's highlight reel: the river cruise, the golf trip, the grandkids at the lake. But the highlight reel is maybe 5% of retirement. So here's my question. Describe an ordinary Tuesday, February, 2 years in, no trip on the calendar. What time do you get up? What's the morning for? Who do you actually see? Most people can't answer, and that blank is more dangerous than it sounds, because 30 or 40 years, what do you do? Had an easy answer. The title, doctor, teacher, engineer. The day you retire, the title, the calendar goes blank, and so does a piece of your identity. Researchers have actually mapped this. Gerontologists describe a honeymoon phase. Everything's great. Every day feels like Saturday. That typically fades somewhere between 3 months and 2 years. What comes next depends on whether there's a life waiting behind the vacation. And this is not soft stuff. A study in JAMA Network Open followed nearly 7,000 adults over 50. The people with the lowest sense of purpose were more than twice as likely to die during the 4-year follow-up as the people with the highest. Purpose is linked to longevity. It shows up and mortality tables, not just greeting cards. Now, the next two tests, by the way, are where most people's confidence collapses. So here's your pass line. You pass the Tuesday test when you've written down or said out loud to another human being what an ordinary week actually looks like, including at least one commitment that puts you on somebody else's calendar, such as volunteering, teaching, a standing tea time with people you like, watching the grandkids, maybe on Thursdays. Vague counts as a fail, just so you know for now. But even a perfect Tuesday has a problem if the person you're retiring with is picturing a completely different Tuesday. Test 4, the same page test. Fidelity has surveyed couples for years, and they're clever about it. They interview each spouse separately. Roughly half of couples disagree on the age they'll retire. About a third disagree on the lifestyle they expect once they do. So think about that. Two people, one retirement, two different movies playing. He's picturing golf and slow mornings. She's picturing 3 trips a year and finally redoing the kitchen. Or she's run the household for 30 years and is now facing a full-time co-manager who has opinions about the dishwasher. Nobody's wrong, but unspoken visions don't compromise. They collide. And the stakes are real. Researchers at Bowling Green State University found the divorce rate for people over 50 roughly doubled since 1990. Over 65 roughly tripled, all while the overall divorce rate in America was actually falling. They call it a gray divorce, and it splits one retirement portfolio into 2 retirements. So here's your pass line. You pass the same page test when you and your spouse have each answered 3 questions separately, then compared answers out loud. 1, what does a great ordinary week look like? 2, how much do we travel and spend in year 1? And then 3, what does my retirement change about your day? If you haven't compared answers, by the way, you're both assuming, and at least one of you is wrong. So just forward this video to your spouse, otherwise the time watching it will have been partially wasted. Which brings us to the final test, the one I told you about at the start, the one that best predicts regret. Test 5, the toward test. Are you retiring toward something or just away from something? Because everybody knows what they're escaping. The 5 a.m. alarm, the meetings that should have been emails, the boss, but removing a negative doesn't install a positive. It installs a vacuum. And here's an honest piece of research most videos won't tell you. Studies on retirement and mental health are just genuinely split. Some find depression risk drops after retirement, some find it rises, and one of the biggest things separating the two, whether retirement was chosen or forced, aimed at something or escaped into. The honeymoon phase will carry you either way for a while. Then it wears off, and the person who only retired from something is just left with nothing on the calendar. So try this diagnostic. If your boss offered you 20 hours a week, total flexibility, only the parts of the job you love, would you take it? If you hesitated, you're not running toward a life. You're running away from a schedule, and that's fixable, but not by a retirement date. So here's your pass line. You pass the toward test when you can say in one sentence what your retirement is actually for. And you've already started a small pilot version of it while you're still working. If you can't start the 2-hour-a-week version now, the 40-hour version will not magically appear on day 1. So let's score it. Test 1, spending, 12 months of real data, lumpy expenses included, 10% buffer. Test 2, bad timing, 3 to 5 years of withdrawals you could take without selling stocks down. Test 3, Tuesday, an ordinary week you can actually describe with one commitment on someone else's calendar. Test 4, same page, 3 questions answered separately, compared out loud. And then finally, test 5, toward. 1 sentence about what it's actually for, already in pilot. So which test resonates with you? Type your answer in the comments below. I'd love to hear from you. By the way, what's your score? Here's the good news. Failing a test today doesn't mean you can't retire. It just means you now know exactly what to fix. While it's still cheap and easy to fix, every one of these is fixable before you hand in your notice. And by the way, if you're thinking, Mark, nobody can predict the future, no test changes that. You're exactly right. These tests aren't predictions. You don't pass by knowing what's coming. You pass by having a plan that doesn't need to. Your next step, grab a personalized strategy session with one of our certified financial planner professionals here at Covenant to see how we can help you retire. Just type strategy session in the comments and I'll send you a link where you can sign up for free and we'll see where we can help you, if at all. The truth is, you spent 30 years studying for the money exam. Give the life exam just one honest week, because Tom and Lena's projection was never the problem. The actual inputs were. That's true of your spending, and it's true of the life you're planning as well. That's really what we do here at Covenant. Retirement income, taxes, investments planned as one, because that's how they actually work in real life. And by the way, if you want the 3 things that matter more than your portfolio once you're in retirement, that's this video right here. We'll see you on the next one.